Hi guys, Max here, and yesterday was a really interesting and quite a volatile day in the markets for the equity market in particular. Now, as you can see, it was still mostly red. Stocks did fall on the whole, but there were some touches of green. Consumer defensives and consumer cyclicals did okay. Amazon and Tesla were up by 1 and almost 2% each, and that's a little bit surprising to a lot of people because the news that came out was really quite damn bad. CPI data from the US came out and it was 9.1% year over year, which beat the expectation of 8.8% by a fair margin. So a lot of people were expecting equities to rout for the entire day, which we did see at first, but then stocks started to recover and it all got a little bit weird. Now, I went really into depth in a video yesterday looking at the CPI data, explaining exactly what's going on, and then establishing why actually the data is even worse than it might seem on the surface. How did the markets perform then? Well, the S&P 500 fell by 0.5%. The Nasdaq doing actually okay for once, only fell by 0.1%, and the Dow Jones did a little bit worse, falling by 0.7%, with the Russell 2000 falling by just 0.1% as well. Across the rest of the world, things were a little bit better, but still nothing incredible. There are some big spots of green about, but on the whole, indexes did still fall. The FTSE 100 fell by 0.7%, and the Stoxx 600 fell by 0.9%, and then the MSCI World Index, so every stock in aggregate, fell by 0.4% on the day. Again, basically on this news that maybe inflation hasn't actually peaked and there's worse stuff to come. Now, as for currencies, we actually didn't see any major moves in either direction. The euro is still sitting at about $1 each, although it has popped up just to $1.01 after falling down briefly to 99 cents. The pound is still sitting at $1.19, and the yen is still sitting at 137 yen per dollar, so no major moves in foreign currencies. As for fixed income assets, we saw yields decline slightly, but not by a huge amount. The US 10-year Treasury yield fell by about 6 basis points to 2.91%, and then the British and German 10-year yields, well, they fell by 1 basis point each, so not much volatility in that market. As for oil, well, prices are remaining slightly depressed, which is very nice to see. WTI crude oil is sitting at about $95 a barrel right now, with Brent crude sitting at about 99. In the world of gold, we actually saw a slight rise by about 0.5%, with the price of gold sitting at about $1,730 an ounce. Now, maybe that rise was gold acting as sort of an inflation hedge. That's what a lot of people would like to think. But to be perfectly honest, gold just hasn't been behaving as much of an inflation hedge. It's certainly been doing far, far better than Bitcoin or cryptocurrency or really any equity except for energy stocks for the last year, but it still hasn't been exactly stellar. Now, what did we see in the crypto markets? Well, not a huge amount of change over the day, although there was some decent volatility as this CPI data came out. When we got the news that inflation was actually getting worse again, well, Bitcoin and the rest of the cryptocurrency market did dip a fair bit. Bitcoin fell close to $19,000, but we then saw a decent recovery for the rest of the day. So on the whole, it really wasn't anything major, and the market's sitting pretty much exactly where it was the day before. Now, I've seen some places claiming that this is evidence that Bitcoin is behaving as an inflation hedge, but actually Bitcoin is down from a few days ago, so I really don't understand that point of view at all. Now, the big news was, of course, the CPI data report. Now, as I mentioned earlier, we covered this in loads of detail in a video on its own yesterday. So if you haven't seen that, go and check it out. We're just going to touch on some of the headline things here today and then give a bit more context and talk about a couple central bank moves. Now, the headline stuff was a 9.1% year-over-year inflation data, which was 0.3% higher than the consensus amongst economists and the markets, which was 8.8%. And there weren't really any silver linings in this report. It was bad across the board. There was inflation across the board. This is, of course, the newest worst figure for inflation in the United States for 42 years. And inflation is actually far higher than it might seem on the surface, according to the CPI data. The Federal Reserve and the Bureau of Labor Statistics do manipulate this data to try and keep the number low so that they can maintain the status quo of quantitative easing and 0% interest rates for as long as possible. In short, though, things are just looking quite bad. The Fed might even accelerate their monetary tightening at this point. They might accelerate their quantitative tightening, the easing off of their balance sheet, and there's a decent chance that we see stronger rate hikes into the future. The markets are trying to price this in. They're trying to gauge how likely a 75 basis point rate hike is compared to something like a 100-point basis rate hike. And right now, the market estimates that there's a greater than 50% chance that we see a 1% increase in the federal funds rate this month, which would be a massive jump, and that would be pretty damn major. Now, as I mentioned earlier, equities were really quite volatile on this news. They dropped immediately as we got this data, as you would expect, but then they started to recover, and a lot of people are asking why. And to tell you the truth, I just don't know why, and no one else does either. They did perform far better than we would have expected given the poor data. There's the possibility that this is related to the TINA, or there is no alternative idea that we've seen a lot over recent years, where equities are the only sort of alternative because bond yields are so low, but bond yields are actually not so low anymore, and they're mostly higher than dividend yields for most companies in the US, so I'm not sure that argument stacks up anymore. We did get a development from Canada and the Bank of Canada, which has announced a 100 basis point rate hike as they attempt to curb inflation before it gets to an awful situation. They're claiming that they are front loading these rate hikes, and this is making it a little bit more likely that the Federal Reserve and other central banks as well are going to do the same thing as we move on into the future. Now, we also got some news coming out from the United Kingdom, from my home, and the British economy rose over the last month, which surprised pretty much everyone, myself included. We saw GDP grow by 0.5% for May, which is a massive figure and far, far greater than anyone expected. We were expecting negative growth for the most part. Now, this is being talked of here in the UK as good news for the most part, but the problems with this, of course, relate back to inflation. If the economy is booming, if people are out spending money, then demand for products and services is going to stay really high, and inflation is going to keep on rising. So this is a little bit worrying. It also means that more rate hikes are probably coming. The Bank of England has turned a little bit dovish over recent months, refusing to hike rates by the necessary severity because they're worried about shocking the economy. There's a decent chance that this strong data will sort of kick them up the arse and get them moving again, and we might see a 75 basis point rate hike for the UK this month. Another odd thing about this development is that apparently this GDP growth was driven by lots of extra doctor visits here in the UK, which just seems a little bit odd, and again, no one really knows what to make of it. It is worth noting though that for the second quarter as a whole, the UK probably did still see negative GDP growth, and we are probably still right at the beginning of the next big recession. Now, we do have a new development coming out of Celsius, the massive crypto lending firm, which has basically gone bankrupt, and it officially went bankrupt yesterday as it filed for bankruptcy. Now, of course, they stopped withdrawals last month. They basically ran out of money, and so they've had to just tell their clients that no, you can't have your assets back because we don't have them anymore. We gambled with them and we lost. There was believed to be a greater than 1 billion size black hole in their balance sheet, and that has been confirmed by this official release, this official report coming straight from Celsius themselves. Now, of course, Celsius had always claimed that these problems were overstated and that in the end, everything will play out and everyone will get their money back, but that's looking incredibly unlikely at this point. Now, what's actually in the details of this official statement? Well, as you can see, it's long and it's very boring, so I'll just tell you the important notes. The first thing is that the company has $167 million in cash, and it has somewhere between $1 to $10 billion worth of liabilities. That's not good news, and that doesn't inspire anyone with much confidence at all. The best possible situation is that they have enough cash to cover 16% of their liabilities and their debts, and in the worst case scenario, it's far, far worse than that. Now, Celsius have announced that they are going to continue to pay staffs and to run operations, although they are still not going to be allowing withdrawals. They're also bringing in new directors to try and invigorate the company with some new management, some new leadership to try and dig it out of this massive black hole. But of course, that really isn't going to work because directors can't just magic new money. The problems are innate to its business. They don't have the cash to pay off their liabilities. And at this point, it's just a matter of time until it collapses into itself. Now, in a bit of corporate news, we got some development from Netflix, who have been struggling a lot recently. Over the last year, actually, they are no longer growing, in short. They're no longer really considered a tech company. They're no longer considered a growth company either because they're actually shrinking, and they're expecting to lose 2 million subscribers over the next quarter. But they've been talking about innovating once again, trying to bring customers back. And what they've come up with is a cheaper ad-supported tier that's been going through the rounds and seems to be a good idea according to most analysts. Now, they've announced that they've decided to partner up with Microsoft to run these adverts, which is very good for Microsoft. This is going to be a good bump to their business. I do have to wonder why, though, they didn't go with Google, who are basically the king of online ads, and maybe Facebook as well. They're certainly in a better position to start something like this than Microsoft, but I'm sure Netflix do have their reasons. This is actually good news for Netflix, though, in my opinion. Netflix grew complacent. They got addicted to this idea that they were the innovators in the media space and that no one could become more innovative and more disruptive than they were, but they just got complacent and they stopped disrupting. They refused to adapt, and the business model has suffered for that reason. But over the last year, as they've realized their problems, they are finally turning around and actually starting to innovate once more. This is just one example of that. A cheaper ad-supported tier of subscription is a great idea and should help them grow into poorer countries in particular. They're also apparently considering moving away from the binge watching idea where people would watch one entire series in a single night or something like that. They tend to release their shows all in one go, whereas other sites like Amazon Prime Video, they've gone the much smarter route of releasing episodes week by week. The best example of this is The Boys, which has been dominating culture over the recent couple of months it's been out because it's been a long sustained burn, and that means that actually you get more subscriptions for long because people can't just sign up, watch everything they want within a week, and then get rid of their account. They have to maintain it for a couple of months at the minimum if they want to watch that specific show. Finally, then, the last thing we're going to talk about today is that Joe Biden and his administration are heading over to Saudi Arabia. Now, there are a few major reasons that they're going there. The big one is, of course, energy security. They want Saudi Arabia to be producing and exporting more oil. There's also a few minor things like Israeli and Arab relations that Biden is trying to improve. The war in Yemen is obviously very bad and people would like that to stop, and so Biden is reportedly going to talk about that. And then finally, there's this idea that the US wants to strengthen Saudi Arabia's resolve against Iran and build sort of an alliance against Iran in the region. Now, of course, this being a finance channel, most of that stuff really isn't too important for the market, but the bit about oil 100% is, and so that's what we're going to talk about. Of course, Biden is well aware that there are problems with oil prices and gas prices in the US in particular. His approval ratings are at rock bottom, mainly because things are too expensive, and so he doesn't really have much choice but to try and improve the state of things and to get more oil into the markets. Now, this is actually quite an embarrassing thing for Biden to do. This quote here sums it up pretty well. Biden is hardly the first president to run on a human rights will be central to my foreign policy platform, only to be confronted in office by the realities of the Middle East. Biden has rallied against Saudi Arabia in recent years, especially in the run-up to the election that made him president. He was an outspoken critic of the Khashoggi murder and of MBS in general. But the simple truth is that he doesn't really have a choice here. He needs to try and increase the production of oil in the world. He's unwilling or unable to do so in the US, so he has to go abroad to find other people, and that means working with sometimes people you don't like and you don't actually want to work with. This is actually, in my opinion, good news that Biden is heading over. No, I don't really expect him to be talking with MBS himself and to actually come up with a deal himself, but there will be loads of different really talented diplomats going with them, speaking to each other, actually hashing out a deal if there's going to be one made, and I don't necessarily expect them to be successful here. The US has been basically begging Saudi Arabia to produce and release more oil for months now with pretty much no success. But going there in person, having a little bit more influence and showing that you're willing to work with Saudi Arabia and that maybe you aren't as critical of that regime, well, there's a decent chance that that might have a positive outcome for this in the end. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.